Good day and welcome back to the FinChat podcast. So this week, quantitative easing. Phila, you want to start us off?
I think it's very topical right now, especially with the measures economies are taking to kind of avoid crises. I don't know if that's a word in this pandemic. And basically, it's a government and central banks putting money into the economy. And they like saying economies are printing money, but it's not really printing. It's theoretically just a click nowadays. Back in Great Depression days, it was printing. And what they really do is they insert themselves into like the modern economic system by buying government bills and bonds from different commercial banks. So the banks can kind of have surplus cash on them and they can kind of use the cash to give out to more people, that way driving interest rates down in a sense, because they don't want to keep all the money on hand, but they don't want to keep interest rates too high or else no one is taking out any type of debt. And that's basically what quantitative easing, or QE as it's commonly referred to, is. And it just lowers the cost of borrowing and it stimulates some kind of effect in the economy, some kind of lending in an economy. So it just stimulates that.
Yeah, I think that fits into the monetary theory where monetary policy is basically the injection and withdrawal of money from the financial system, right? And the quantitative easing fits in where money is created from nothing, right? So the injection of money is by reducing interest rates, right, to increase the borrowing activity. But then they do the separate thing. What they can do is, like, if you look at a central bank's balance sheet, right? I think in the asset side is where the cash sits, and then to create that cash, they don't have equity to create on the financing side. They have to increase their debt, right? So they create the governmental debt increases to create that asset. It's literally just a debit and credit that they journalize, and then they use that debit, that bank, their cash balance that they now increase to actually buy government bonds and buy from the secondary financial markets. The secondary financial markets is what we have access to by through the JSE or whatever. We don't really have access to the primary market. The primary market is where something is listed. So that's when a company actually goes and sells it the first time. So like an IPO is the primary market where they sell it directly from the company. Secondary market is where it moves between the two of us. So if I have a government bond which is sitting on 50 rand to 100 rand or 50 cents to $1, and the government buys it from me at 70 cents to the dollar, they're obviously increasing financial asset values, and that's how they push back the market. So that's what we're seeing in America at the moment, where they had this massive dip in the coronavirus, and then they released the $2 trillion stimulus package, and now they're increasing that to $3 trillion, and I think they have a big plan to increase it even further. And that's where the whole problem with inflation comes in, but we'll get to that a bit later.
And just to break stuff down a bit further, to get like more layman's termsy, bonds and bills are debt instruments. For those of you guys who don't know, bonds and bills is just obligation for a company or government institution to pay you back on a specific rate on a specific date. And so the Fed or any central bank does normally do stuff like quantitative easing, but like what makes quantitative easing specific is just the scale at which it's done. It's done on a large scale, and just the stuff that they invest in.
Especially in America.
Yeah. So it's not just government bills and bonds. It's bills and bonds from all banks. And in modern economic theory, we saw it kind of being done on a large scale after obviously the 2008 financial crisis, where a lot of these big banks had like these weird, ugly assets on their balance sheet. I mean, this weird, ugly debt on their balance sheet, and it was offloaded to the government so they could carry on just essentially being banks, I guess, and lending to the general public. And that's how quantitative easing generally works. But I want to hear from Josh. A large criticism of it is, yes, governments are very quick to implement quantitative easing, I'm just going to say QE, programs, but concluding them and kind of rolling back because they do have to roll back tends to be a problem. What do you think about that?
Just explain your question a bit.
So like concluding them and kind of offloading these bills back into the market often tends to be a problem, and governments
they don't do that.
They don't really conclude. but they're supposed to, because it's supposed to have a conclusion. It's not a permanent thing. It's just to
Yeah.
kind of ease in time of crises. Why do you think that is?
Oh yeah, so yeah, obviously exactly like you're saying. In the past, they've bought these bills and debt instruments from the markets, from the secondary markets, but they don't almost withdraw that money back from the market by selling it again, because obviously asset prices are dropping, would drop significantly if all this QE or all this all the monetary value is created in the financial markets just by driving up the demand for it by buying it out of the market. If they put all those instruments back in the market, everything's going to go back to what it was. So I think what their plan is, they created that debt, right? Yeah. Their plan is to actually remove that debt over time, to not actually ever sell that back into the market, but to hold it, but to almost decrease its value by inflating it away. Yeah. So the value, so say now a debt instrument, or say now you take out a loan at 10% a year, right? Your interest rate. If inflation is 1% a year, and your salary increases at 1% a year, your effective cost of it would be, your real cost would be 9%, right? The 10% minus 1%. Where if inflation is 12%, now suddenly your salary increases by a larger amount than your debt value increases. So it's easier to pay off the debt, and it almost gives the debt a real value of zero, right? Because you don't get any return on it as the debt asset holder, where you get a lot of value as the debt liability holder, where you have the obligation. So I think what their plan is to actually inflate debt away in that way, to increase inflation but keep interest rates low, which is very, very risky and dangerous, because this hyperinflation can absolutely just be dismal, because if asset holders start seeing that inflation is absolutely eating up their assets in America, so now because of their big quantitative easing, they'll start withdrawing their money from the market, and it could even further devalue the dollar. And that's the big fear of traditional economists and people who believe in traditional monetary theory, that they're scared that hyperinflation could run away with America, especially in a hyperinflation way, because they are printing a lot of money. Their quantitative easing levels are crazy. Yeah.
I think just to add on to that is the main issue is that, like, once the money's in the market, you can't really force, like, for instance, like the banks to lend that money out, because once you provide the funds, you can't really tell them what to do with it, because it's up to them, and like I think I was reading something, and the big issue is, as you just stated now, with traditional economics and what people's views are on quantitative easing is, in terms of the dollar, people are really scared that it'll stop being the reserve currency, because of all of that and all that destabilization that kind of would happen to the dollar.
And China trying to actually, their sole purpose is to decrease the power of the dollar. Yeah. And they want to make yen a major reserve currency in the world. They want to take the power out of the dollar.
It's also, to add on to what Randy's saying, that's actually an actual case study. That's what happened in Japan, where they introduced a big QE process and the banks just held on to the money. And so they've just had like this constant deflation on their currency. And it's just like a practical example of what can happen when banks kind of clamber onto the money as opposed to kind of making it work within the economy and kind of increasing. Would you say, in a sense, that's like destroying currency? If QE is meant to create currency, would you say that just holding on to it?
Obviously, it's easy to understand that if you have one apple between the three of us, we'll be maybe be able to pay 100 Rand for that, or we'll be willing to pay that. If you have three apples between us, we'll pay a lot less for it. Yeah. So it's just the supply and demand. It's easy to understand that if you push a lot of product into the market, the demand or the supply will increase and your price will decrease, right? It's that's easy microeconomics. But I think what's really scary is I think at the moment America, their because I also listen to a lot of modern monetary theorists, right? So modern monetary theory, or MMT, is basically that you can print money or you can do as much quantitative easing as you want, and it won't affect the value of your currency relative to others. So your dollar to euro or your dollar to pound will remain the same even if they print all this money. Because they say if you still control your currency, it won't devalue your currency, which we have seen in the past. I mean, since 2008, the dollar has been, there's been a lot of quantitative easing in America, and the dollar hasn't deflated. I mean, it's become stronger. And that's why a lot of MMT theorists are supporting the quantitative easing, because they're saying, well, it's keeping asset prices up. It's holding those pensions and the 401ks that they have in America. It's keeping that value up and almost saving that value for the people. The problem is America was able to uphold this because their economic growth and their economic stability was just better than the rest of the world forever. So the investment into America has just constantly been good. So the demand for dollar to invest in dollars has been good, and that's been keeping it up. The problem is when America, the economic growth slows down compared to the rest of the world, and there's like a significant, not even significant, just a slight divestment to maybe invest in better yielding, lower risk economies. So say now, we don't know, let's hypothetically say that after Brexit, Britain starts getting proper, stable, good economic growth, then there will be an obvious divestment from America and investment in offshore, and that suddenly might create a crisis where everyone's like, whoa, there's so many dollars, and the inflation, because everyone now has dollars, and there might just be a massive dump of dollars, and the inflation in America will just devalue the currency. I mean, if we actually look at purchasing power, it's a lot more expensive to live in America like in South Africa. Yeah. But the currency is stronger than ours, right? Yeah. Like what they pay compared to their salaries and living costs for Big Mac, that's how they measure per like living costs. Like it's a lot easier to afford a Big Mac in South Africa. A lot more people can afford a Big Mac. So if quantitative easing, if in America what they did now with coronavirus, they gave each citizen, I think, $12,000, something like that. They gave them a big check, cash. Yeah. What happens with that is people think now people are richer. They aren't. If everyone gets it, all the prices just increase by that same margin, and inflation just kills everything that's pumped into the economy. So that's the scare that they think would happen if there's divestment from America, because I don't know exactly what would happen, but I would think that companies would, to keep their returns up, to get the investment back, there might be increases in prices, there might be increases in margins, inflation will start pushing up, people would. I just think it's a scary thing that might happen if America's economic growth slows down, or even if the yen starts becoming a more dominant global currency, or people start trusting in China, which I don't know what would happen there, but if people start actually valuing that a bit more, even with a cryptocurrency, the first government that's coming out with actual cryptocurrency, backed by, I think the reserves are gold or something like that. Okay. People would maybe start using that rather than using dollar, because there are a lot of people that are starting to believe in gold again, starting to believe in Bitcoin, the whole story of Bitcoin. It's scary.
I think our QE, especially during this pandemic, will kind of define modern economic theory, because I think it'll teach us the extent to which we can implement a QE system. And I say this because before we started a podcast, we were talking off of air, I guess it's called F-air. We were talking off of air about how I read an article that headline said that $80 billion have been implemented through QE every month into America's economy. So I think it'll make an interesting case study of, is there ever too much QE that can take place, and just the balance between that.
And actually, I wanted to jump on there because I think based on like both of what you guys said, I think it's really important. But my question then to you guys is that is QE then actually worse for inequality?
Definitely. QE is 100% to keep asset prices up, to keep the financially wealthy.
Just
I mean,
think about towards access
Yeah.
to
inflation
who has a direct investment in these assets
Yeah.
that they're keeping them up.
Inflation, that's what I'm saying. Inflation isn't bad for the rich. It's really bad for the poor because the poor's wages are low. If things become more expensive, they can't afford food. And the whole criticism, and that's why we see in South Africa, we have a massive dependency on the fiscal policy. I've said this previously. And even in this coronavirus, you can really see what the difference is between the South African economy and the American economy. American economy is 100% capitalist system. So they have a heavy dependency on the monetary policy, right? That's where you really see any fiscal, or they maybe have tax reforms now and then. Yeah. They don't really play too much with taxes. They keep taxes low. They have different tax legislations and rules in different states. So it's easy to move taxes around. I know in Delaware, if you register there, you almost pay no tax. So there are a lot of like the fiscal impact on the economy is minimal in America, where they very largely dependent on their monetary policy and the Fed, their central bank. That's why they're seeing so many quantitative easing things to keep the asset prices up, because they're just pumping money into the financial system to keep that up, to keep the rich, right? In South Africa, I think our governor of the Reserve Bank has done a really good job, because he knows that if we start printing that money, no one would want the rand. I'm sorry, no one wants to. South Africa isn't that amazing for everyone that they'll keep on investing in South Africa even if we keep printing money. America has that they have that stability, they have that track record, they have, maybe things have become shaky in global economics due to Trump, but they still have their infrastructure is crazy. The industry that they have there is just, they're so developed in that way that people almost disregard the quantitative easing, which might change that we talk about now if the economic growth slows down. When South Africa, if we start printing money, we are going to be in big trouble. No one is going to want the rand if we start pumping rands into the system. That's why we've seen it's crazy, the disparity between the two stimulus. In the monetary policy, I think we just announced 10 billion rand, which is almost nothing.
Yes.
Yes. That's a whole monetary policy stimulus through quantitative easing in South Africa. And Lesetja Kganyago, our governor of the SARB, has really been looking carefully at our price stability. And I think they're doing actually a fantastic job to keep the financial system stable. Where if we look, that 10 billion compared to the trillion rand that we're borrowing for fiscal stimulus, for government spending, right? So fiscal stimulus is done in two ways. It's either by borrowing money from the government borrows money from overseas and then spends it in the system, which creates a multiplier effect in the system, creating value. But obviously, that value needs to be created faster than the cost of that debt is to be able to pay back the debt. Other way for the government to get money to stimulate the economy is through taxes. But there's obviously diminishing returns if taxes become too high, because people won't want to be in South Africa. They rather take their money overseas. So then there's massive divestment also.
I also saw, interestingly, that someone said that what would happen if we increase taxes again in South Africa? And just adding on to your point, who else would get taxed?
We can't increase it anymore.
Who else would get taxed?
We're already past the tipping point.
It just wouldn't be an attractive investment, which already is very shaky given the stability, political stability, and just developing country problems. But that is very interesting. Like you said, our reliance on fiscal and monetary policy as different nations.
I think like that got me thinking as well, is that obviously it goes back to obviously now evaluating what works for a country, and like a lot of people, like I've heard this a lot on like finance Twitter, of like, is QE then now appropriate for South Africa? So now, I mean, you're shaking your head.
No,
So,
it's not going to work.
so now, with that being said, then, why? What signal are we trying to send out?
I don't think it's as much as a signal, rather than just basically if we pumped rands into the system.
What value would they hold?
Yeah, literally people won't want to buy them. Overseas, people are not going to look at it and say, yes, I want to buy more rands. What's going to happen is the demand's going to stay stable, but the supply is going to increase, which just brings down the price.
Yeah.
So it's just going to kill our economy. It's not like they're printing rands as if the demand for the rands are increasing. Then there might be price stability, because if the demand increases at the same rate that the supply increases, the value stays the same. Where I don't think our financial market isn't that developed.
Yeah,
yes, a lot
probably.
of pensioners are becoming it has a massive hit on them. But I think why the global economy is heavily dependent almost somehow to one another. So just because the American markets rally, sometimes the South African markets also just rally, just because of that.
Yeah.
Just because the Eastern markets open first, and if they rally, then there's a good day on the JSE.
And sometimes
Right?
it works opposite too.
Sometimes it works opposite where, but like a great phrase is when America sneezes, the whole world has flu. And that is the dependency that we have on America. That's why they can implement a sort of MMT. Yeah. With us, if we sneeze, no one's going to care. Yeah. Literally, no one's going to care. That's what happened with Zimbabwe. They think they could print money. It didn't work. And that's why Lesotho Kganyago is saying, no, we're not doing that. We're not going to print money. Maybe we can borrow money, bankrupt our state, but that's not his mandate. His mandate is look at inflation. Is inflation stable? Yes, our inflation is low. That's why we're cutting interest rates to increase the borrowing activity. We're not going to pump money into the system because our rand isn't appreciating with our inflation our inflation lowering, which should happen theoretically. If our inflation lowers, our currency should become stronger because of inflation parity. And with a decrease of the interest rates, our rand should also appreciate according to the futures and the futures market. But it's not happening. So why would we then do quantitative easing? We're just going to kill the rand completely. Yes, okay, actually, what could happen is it could make it a lot cheaper to invest in South Africa. And but then we're going to need really governmental regulation, specifically price regulation, to keep prices stable, to keep the poor safe.
Do you see us getting to a level somewhat in the future if we got our stuff together that could allow an effective QE program should something like this happen
if the
again?
world becomes dependent on a certain resource that we have? So back in 2000, South Africa had 80% of the gold resources in the world, right? Literally, that's and I got extremely upset when I got to know this, but then it made sense why, because our gold industry absolutely boomed then, right? But we started exporting all our gold. We kept nothing here. But the world was sort of a bit dependent on us for gold, and gold is a safe haven, whatever people think value they add to gold. And that kept the rand value quite strong. I mean, the rand to dollar was 6 rand a dollar or something like that.
Some beautiful numbers.
Very low. Right? The world is not dependent on South Africa for anything. Yeah. Maybe for food here and there, but now we're telling our farmers, you don't own your land anymore, so now what now? Yeah. So that creates people wanting to reduce their dependence on South Africa because of the political instability, and because they're not dependent on us, they could just write us off.
Yeah,
if that makes sense.
In that direction, yeah.
Because the world is dependent on America. That's why the dollar stays stable. If we don't create some industries where the world is dependent on us, dependent on the economic success of South Africa, we won't have that. We won't have the luxury to have quantitative easing.
On that train, what are we looking at in terms of innovation? Just going on that train, then what do you guys think South Africa would be like?
How can we make people dependent on us? Other countries dependent?
Because I think we've mentioned this a couple times. Our financial services sector is
Yeah, that's our strongest.
Dependency though.
No, but in
Financial
terms of like,
services is strong, but
Yeah, the whole world has good financial services
to
though.
create a dependency though.
Like if they owe us money, that's one way that you have to be pretty dependent on someone. But we don't have the money to invest somewhere else that they owe us money. Food, maybe. I think that's Africa's biggest plus. I think that's Africa's biggest resource that we have that the rest of the world has less of. I think the African natural resources are really great. We aren't as industrialized as the rest of the world. Our CO2 emissions are a lot less. So there's less. Yes, we have some places where the pollution is crazy, but most of our land hasn't been used yet. And I think actually something great that I think we can do, which I think India has been doing well, is create tech dependence. Because we actually have great talent in South Africa. We have very clever people. We have proper tertiary education. If we start exporting tech and people have to pay us in rands, that could keep up, that could create a dependence on us. But if we create a tech dependence where we export tech, so say now, for example, when I spoke to Marnus from Pineapple and the startup stories just went out last week, he said we have a great opportunity in South Africa to export tech products. So what they're actually doing with Pineapple is launching in America now. And their tech is actually almost groundbreaking in America.
Josh, no, we've talked about this, right? This exact train of thought on a podcast.
Yeah.
Like what you're saying now, almost word for word, you've said on a podcast.
Is it?
Yes.
deja vu. I was sitting, I was like, deja vu.
I've heard this before,
So, but that dependence that we can create in South Africa, if we create similar products, so now we create fintech companies that could service Latin America. The whole South America is dependent on South Africa to solve their financial services needs, right? That creates a dependence on South Africa. If we create even tech for Africa, it creates a dependence on Africa. So you need to grow the dependence helps us get leverage to negotiate better, be in a tighter, to manipulate things. Like if you look at America, they're extremely
manipulative.
No, they can just be. They can do what they want. They're reckless.
Like the ban with
Honestly,
TikTok.
there's $3 trillion of quantitative easing.
Yeah, that's insane.
That's literally like 3 out of 20. The GDP is $20 trillion.
That's
and now
country's GDP.
And then they pump. It's bigger than our GDP.
Yeah.
They're literally taking the South African 10 times the South African GDP and literally just pumping it in. They can do that. They can do what they want because the world is dependent on them. Look at all the products that we use, all the tech that we use, all the services that we use. Everything's from America.
And I was thinking, I was just like because I think I saw like this thing going on Twitter where people complaining that we need to start supporting Africa and South Africa and push foreign things out. But I'm like, okay, what are you using? What device are you using to spread this message? Oh, it's an iPhone. Where's that from? Oh, America.
I also think
and then it's like, okay, you're using Twitter. Where's that from? America. Okay, so man, listen, what are you going to use to get your message across? And it's not
like we're very happy with what we have.
Yeah.
Like we say, if you say that, then just watch DSTV.
Yeah.
But we can't. I get so frustrated with DSTV now. I
watch the sports channel only. That's the only thing. I get home, I just put on Super Sport.
Yeah, so because we don't have enough money to pump into these things to create products that are actually quality compared to America.
I also think a big problem is we try emulate the products America already has way too much. So we'll see, and we talked about this last week, we'll see a unicorn in America and we'll emulate everything, and it's just like, but I could just go and get the services from the unicorn in America. Why would I try to do that? And I think, especially with the provision of services, it has to be accompanied by an immense innovation in order for us to make us stand out and really create a proper dependency, as opposed to creating what's already in the marketplace just in a different part of the world and saying, support this South African variant of this. Yeah, sure, we can improve on some business modules, but I think a lot of it, and we're seeing it like with insurance as well, a lot of it has to come with like a whole bunch of innovation.
Yeah, so it's very difficult because we need to create similarly quality products if we want to emulate, or we need to create completely new things that is specifically, and I know Phila spoke about this a lot also, is creating specifically African solutions, because that's something that they won't be able to emulate, and that's something that we can create uniquely.
It's something that the rest of Africa can have dependence on us for.
Yeah.
How we kind of understand the marketplace better than a Western country would.
And I think it's also very important to understand like how this affects you, you know. So like the biggest things, what I've noticed is that like we look at all these topics and we look at like everything that we discuss, you know, like how understanding how it affects you and how it affects your future is really important, you know, because one thing I've learned, and even I've been you know, playing this role too, is a sense of like I see all of these things. And then it's like, oh, I mean, but like, yeah, that's just like, you know, government and like, you know, private sector. It doesn't really affect me, you know. And then you go to the store and Colgate's up like £2, you know. So it's like, it's really important to understand like how this affects you. And if you understand that and you'll better educate yourself, you know, you learn something new, you know.
I think that is a very interesting point you make, and not just with Colgate going up with £2. So I think the most obvious implication is inflation. So the general increase of prices because there's more money circulating. But should also the banks utilize the amount of money they do get from QE properly? If you are looking at getting a loan for a house or a loan for a car, or a loan to go to university, and you got to the bank and it was more expensive, I think just QE measures in these times where banks are more reluctant to loan out money because it's riskier and thus is more expensive, drive down these interest rates so people can continue taking out these loans and using these bank services. So I think that's also a huge effect on just ordinary people and their purchasing power in a sense.
All right, and that's all we have time for today. So we got a new podcast out. Phila, you want to tell us something about it?
We have a new podcast out. It's called Startup Stories. It's about startups and their stories. Every Thursday, check it out. We just did an episode with Pineapple Insurance. Really cool episode. Check that out. And yeah.
Audio quality is really good there. And we have another podcast out, the personal finance segment. I'm still waiting for a catchy slogan, but when I get one, I'll let you guys know. Remember to follow us on all our social media platforms. Our handle is @FinChatCo. We have a newsletter, a weekly newsletter that you can just sign up for. Follow the link in our bio and all our social media platforms to sign up. And we'll see you again next week.